BlackRock, the world's largest asset management firm, is making massive moves in the stock market, and they're doubling down on some of the most powerful tech stocks in the world. In this video, we're going to break down 3 major stock purchases BlackRock has made, each worth billions of dollars, and what that could mean for the future of these companies. These are not just any stocks. Each one is at the forefront of artificial intelligence, cloud computing, and cutting-edge innovation, making them some of the most exciting opportunities in the market right now. First, we'll look at a tech giant that dominates both e-commerce and cloud computing while seeing massive profit growth despite already being one of the biggest companies in the world. Next, we'll dive into a semiconductor powerhouse leading the charge in AI and high-performance computing. This company's innovations are fueling the AI revolution, and BlackRock is going all in. Finally, we have a software and cloud leader that has built an empire of subscription-based revenue streams while aggressively expanding its AI capabilities. With billions of dollars flowing into these stocks, BlackRock is making a clear bet on the future of AI and tech. The question is, should you follow their lead? Let me know your thoughts in the comments. And if you're serious about staying ahead of the market, hit that subscribe button, like, share, and turn on notifications bell so you're always updated with the latest investing. Now let's dive in. The third stock that BlackRock has been heavily investing in is Amazon, ticker symbol AMZN. Over the past few quarters, BlackRock has continued to increase its stake, recently adding another 21 million shares to its holdings. This latest purchase has brought its total investment in Amazon to over $150 billion, now making up more than 3% of BlackRock's entire portfolio. While a 3% increase may not seem like a dramatic shift, the reality is that this translates to a staggering $25 billion investment. For any typical hedge fund or asset management firm, a purchase of this magnitude would be unprecedented. It serves as a clear indicator of BlackRock's influence in the financial markets and its confidence in Amazon's long-term potential. Why is Amazon such a strong investment? Amazon has long been a dominant force in multiple industries, particularly in e-commerce and cloud computing. Its Amazon Web Services, AWS, division is a key driver of profitability, generating massive revenue through cloud infrastructure that powers businesses worldwide. Many companies lack the resources to build and maintain their own large-scale data centers, which require expensive servers, processors, and enormous energy consumption. Instead, they rely on Amazon's cloud solutions, paying ongoing service fees that provide Amazon with high-margin, recurring revenue. This trend is especially relevant in the era of artificial intelligence, AI. As AI adoption expands, businesses will need more powerful computing resources, making Amazon's cloud computing services even more indispensable. This creates a long-term growth opportunity that is difficult to match. Amazon's explosive growth and financial strength. Amazon's financial performance reflects its market dominance. Over the past year, its net income nearly doubled, soaring to $60 billion. Even more impressive, Amazon's total revenue surpassed $500 billion and continues to grow at a double-digit percentage annually. Despite its already massive size, Amazon still has significant room for profitability expansion. While its revenues continue to scale, the company has traditionally prioritized reinvestment over profit maximization. However, as it shifts more focus toward operational efficiency and profitability, its earnings are expected to surge. Is Amazon still a good buy? Even though Amazon's stock price has reached all-time highs, it remains a compelling investment for long-term investors. Forward-looking metrics show that Amazon is more attractively valued than many assume. Its forward price-to-earnings (P/E) ratio is currently about 80% lower than its 5-year average, suggesting that investors are paying much less per dollar of future earnings than they have in the past. Additionally, its PEG ratio, price/earnings to growth, is in line with the broader industry, reinforcing that its valuation is reasonable given its high growth potential. Why BlackRock's purchase matters. BlackRock's massive investment in Amazon signals strong confidence in its long-term potential. As one of the world's largest asset management firms, BlackRock's buying decisions often serve as a barometer for market trends. Their continued accumulation of Amazon shares suggests that they see sustained growth ahead, particularly in cloud computing and AI-related services. With Amazon's expanding dominance in multiple industries, including retail, streaming, advertising, and logistics, it remains a top-tier stock for investors looking at long-term growth opportunities. Given these factors, Amazon easily secures the top spot on this list of major stock acquisitions. Now, let's take a look at the next major stock purchase. One of the most significant stock purchases BlackRock has made recently is in Nvidia, ticker symbol NVDA. The asset management giant added another 38 million shares, bringing its total stake to an astonishing $250 billion, now making up more than 5% of its overall portfolio. Why is BlackRock betting big on Nvidia? A clear theme in BlackRock's recent investments is its heavy focus on AI-related stock. The firm is positioning itself to capitalize on what it likely sees as a once-in-a-generation technological shift, with Nvidia at the center of this revolution. Given Nvidia's role as both a hardware and software leader in AI, it makes sense that BlackRock wants to expand its exposure. Nvidia's role in AI and data centers. Nvidia has solidified its dominance in AI computing with cutting-edge advancements in GPU and CPU technologies. Its latest Blackwell GPUs combined with Grace CPUs have shown a 30x performance boost compared to the previous Hopper generation, while consuming 25x less energy. This combination of power and efficiency is critical for AI-driven workload. Japan is already leveraging Nvidia's technology to build its most powerful supercomputer, backed by SoftBank, a key partner in the massive $500 billion Stargate project, an ambitious initiative aimed at constructing data centers on an unprecedented scale using millions of Nvidia chips. Looking ahead, Nvidia's upcoming Rubin chips, built on an advanced 3-nanometer process with upgraded high-bandwidth memory, HBM4, promise even greater efficiency and performance gains. Nvidia's growing influence in AI software. Beyond hardware, Nvidia's software ecosystem is another game changer. AI platforms like Omniverse, Nvidia Drive, and Metropolis continue to expand their reach, while its new AI agents and blueprints allow businesses to automate workflows and build custom AI systems, all powered by Nvidia's hardware for optimal performance. Explosive financial growth. Nvidia's financial growth has been nothing short of remarkable. Since the pandemic, its revenue has surged more than 18x, with profit margins consistently above 70%, making it one of the most profitable semiconductor companies in the world. Despite its stock skyrocketing over 1,000% in the last 5 years, its valuation remains attractive, trading at a 30% discount to the sector on a PEG ratio basis, an indicator that factors in growth potential. Is Nvidia still a buy? With Nvidia's market cap surpassing $3 trillion, it is now the second most valuable company in the world, just behind Apple. While its rapid rise may make it seem overvalued at first glance, its long-term prospects in AI, cloud computing, and autonomous systems suggest that there's still significant upside potential. When you consider Nvidia's dominance in both AI hardware and software, along with its record-breaking financial performance, it's easy to see why BlackRock views it as a cornerstone investment. This stock is in the same league as Microsoft and Amazon, making it one of the most compelling AI plays in today's market. The final stock on BlackRock's buy list is none other than Microsoft, ticker symbol MSFT. The asset management giant has increased its stake by another 14 million shares, pushing its total investment close to $250 billion, representing nearly 5% of its total portfolio. One of Microsoft's biggest strengths is its exceptional profitability, which continues to expand at a double-digit rate year over year. Despite its massive size, the company consistently grows both revenue and net income, keeping pace with other tech giants like Amazon. What's particularly impressive is that while Microsoft generates less than half of Amazon's total revenue, it still manages to pull in over $30 billion more in profit. That speaks volumes about its high-margin business model, where most of its revenue comes from recurring subscription-based services that keep users locked into its ecosystem. Microsoft has mastered the art of customer retention across multiple sectors. From Windows and Office 365 to LinkedIn, GitHub, Xbox, and Azure, the company has built a portfolio of services that generate consistent, high-margin revenue. However, the biggest growth driver for the company right now is artificial intelligence. With its AI-powered Copilot, Microsoft is embedding AI into its core products, making them even more indispensable to businesses and consumers alike. Cloud computing is another major contributor to Microsoft's long-term growth. Azure, the company's cloud platform, is the second-largest cloud provider in the world, trailing only Amazon Web Services, AWS. Yet, it continues to expand at an impressive rate, growing over 20% each quarter, with profit margins above 70%. To solidify its position in AI, Microsoft has pledged to invest an additional $80 billion into AI-powered data centers this year alone. Only a handful of companies, such as Amazon and Google, can afford this level of investment, further reinforcing Microsoft's dominance in the tech space. Is Microsoft still a buy? Much like Amazon, Microsoft has been a stellar performer in the stock market over the years. While it's not a cheap stock by traditional valuation metrics, its long-term growth potential makes it an attractive investment. Between AI, cloud computing, software subscriptions, and enterprise solutions, Microsoft is well-positioned for sustained growth. For any investor focused on long-term wealth creation, owning both Microsoft and Amazon seems like a logical decision, as both companies continue to shape the future of technology.